Hi, everyone. Thanks for joining us. It's great to see so many of you here today. We love any opportunity we possibly can have to connect with you all, in spite of being in the midst of hopefully the tail end of this pandemic. Our offices continue to remain closed. Our staff continue to work remotely as many of us are becoming fully vaccinated, and I'd like to say bulletproof. We're returning to the office and returning to in-person meetings on an as-needed basis. I think it's fair to say that at some point in the summer, we will resume in-office work, although I'm not sure what normal is going to look like after this pandemic. We've learned a lot. I think it's fair to say that we'll all be working somewhat of a hybrid schedule from here on out, but our offices will start being open at some point, and we'll announce when that happens. Your generosity over the last year has been remarkable. Those of you who have donor advised funds, just want to express our gratitude for really stepping up and making extra grants out of those funds, because our state needed it, and you all responded, and we're grateful for that. Couple little operational updates I want to give you here, so you know who the players are. We are happy to announce that Kylie Gursky has taken the reins of the Women's Foundation. She's based in our Missoula office, and she will be fully integrated into our team very soon. She just started a couple weeks ago. So we're happy to have that position filled. Many of you knew Jen Ewell, who has moved to the University of Montana. So Kylie is stepping in and is going to do great things with the Women's Foundation. Secondly, happy to announce we will be adding a new staff team member in our grants department. So for the first time ever, we're going to have a full-time program officer who's dedicated to grant making and helping you make effective grants. Seeing the incredible growth that we've had as an organization, and also just knowing how important it is to get those dollars out into communities, we realize that oftentimes we need somebody to help with that work. So Eliza Fiaschetti is going to be joining our team in early June 2nd. Some of you might know her from her work with the state's Main Street Montana project. So she's starting in early June with us. And she'll be reaching out to many of you, because our goal is to make sure we get those dollars out to Montana communities. You know, one of the data points that we often use to measure our success is our total assets, and our total assets have grown quite a bit. We're just over the $150 million mark in total endowed and non-endowed funds. But really a more remarkable number that we are starting to practice sharing is the impact that we've had in our state. And we're so proud of the fact that we've been able, with your partnership, to grant well over $85 million across Montana since we started as an organization. And we think that's a really important number to remember. So with that, a big part of our success is our investment performance. And we couldn't be more thrilled to have an incredible partner with Cambridge Associates, and specifically Omar Sanchez and his team. We sent out an email noting him as our chief investment officer, and somebody asked me when we'd hired somebody, and it was like, oh, we meant to say outsourced chief investment officer. So even though he still lives in Boston, and even though he continues to be employed by Cambridge, we like to think of him as one of ours. So with that, I'm going to just turn it right over to Omar and say, thanks everybody for patching in, and take it away, Omar. Thank you.
Thank you, Mary. Very good to see you all today. I am your chief investment officer, so there's no doubt about it. You should always think of us that way. We are your investment team. I am joined today, speaking of my team, by Tim Shepard, who's my director of portfolio strategy, and Sam, who is going to do, as she always does, an able job of driving this presentation, as well as doing all the major heavy lifting on any sort of analysis that we do. So, Sam, why don't we get started? Let's start on page 4. And we'll try to be as relatively brief as we can so that we can leave plenty of time for questions throughout and at the end as well. This is what we call our portfolio highlights page. In fact, we actually review this every single quarter when we meet with the committee. It's really meant to provide, at a high level basis, every piece of information from a performance, positioning, market value perspective that you would want to know as you try to understand what's happening in the portfolio, how it's performing, and so forth. So just looking at the upper left-hand corner here, 115.4 million as of the end of the first quarter of this year. Asset allocation, and we'll spend a little bit more time on this when we talk about our investment philosophy, but asset allocation is in that portfolio snapshot table in the center of the page. We've got just shy of 58% in public equity, about 7.5% in private investments. So call it two-thirds of this portfolio invested in assets that are meant to drive long-term growth, both between public and private investments. We also have 17% in what we refer to as diversifying strategies. These are a range of different types of strategies. You could think of them, if we were to generalize, as a mix of traditional long-short equity, event-driven hedge funds, as well as some less correlated liquid alternative strategies that we have in that part of the portfolio as well. And the role of these investments is to provide ballast to the portfolio to help us manage the overall risk profile of this portfolio. But I think most importantly, to give the portfolio exposure to alternative sources of return that we can't get elsewhere from the other managers that we use. And so by providing those alternative sources of return, by providing, in many cases, hedged exposure, they help us manage that overall risk profile and ultimately deliver, let's call it, a more attractive risk-adjusted return over time. The balance of the portfolio between inflation hedging and deflation hedging assets, these are assets that are meant to appreciate in really the two scenarios that really can cause impact, negative impact, let's say, on the portfolio. And those are periods of severe inflation shock, as well as severe economic contraction, such as we experienced last year. And so it holds a mixture of inflation-linked bonds, treasuries, and so forth that are meant to provide liquidity, that are meant to provide diversification, and ultimately are meant to help buy time so that we don't have to sell as much from the other parts of the portfolio that are likely not going to be doing as well during those specific types of environments. So looking at the performance directly beneath, this is for the first quarter, and we'll give you some real-time numbers here live. For the first quarter of this year, the portfolio was up 2.7%. That is net, so that is net of our fees, net of manager fees, against the policy benchmark, which was up 2.4%. Very short period of time. I think what's interesting and perhaps more instructive is to look at that trailing one-year return, 37.2% against the policy benchmark return of 35.1%. So some decent value added there, but the return in and of itself is obviously extremely high. The reason for that is because on a one-year look at this point, we're now capturing effectively the market bottom of the pandemic last year. And so what this is just showing you is just how far equity markets have recovered as our economy has slowly recovered and we've had all this stimulus go into our economy. The strength of that recovery in the portfolio value has been really significant. So the final point here, since inception in terms of performance, 9.2 against 9.1, so some outperformance against the benchmark. Looking at April returns, we don't have these in the materials, but we'll give them to you. We estimate the portfolio was up about 3% and then is essentially slightly up in the month of May through the midpoint. So that would mean our year-to-date return is tracking at just over 6% for the year. And the total estimated portfolio value today, or at least through yesterday, is 123.9 million in terms of an estimate. So on the upper right-hand corner of this page, and then we'll get to the agenda, absolute performance drivers. This is just for the first quarter. Basically, we've seen largely in the first quarter a continuation of the strong rally that we witnessed and experienced in equity markets in 2020 from the market bottom in March. Not as strong, but quite strong. And so it stands to reason that our equities were really the major performance driver on the positive basis from an absolute perspective. And that was both our US equity managers and our global equity managers. And then in terms of negative contribution, the treasuries that we have in the portfolio, you will likely not be surprised to hear, you're likely well aware, I should say, that interest rates have backed up, certainly through the end of the first quarter, and generally that trend has continued. And so as those rates have backed up, the Treasury returns have come down a bit, which is to be expected given the environment that we're in, but certainly on an absolute basis, a negative contributor. And then on the relative side, in terms of the relative performance contributors, good outperformance from our global equity managers and our emerging markets equity managers, and some negative attribution coming from U.S. equities and treasuries. Within the U.S. equity allocation, just a reminder that this is relative. And so the managers did make money in the first quarter. It's just that they didn't keep pace with U.S. equities, which are up about 6%. These managers were up about 5%. So they did make money, but on a relative basis, had a little bit of underperformance in the first quarter. So what we'd like to do today, very briefly, is just say a few words about who we are as a firm, for those of you who maybe are less familiar. We want to talk about our investment philosophy because it really informs everything we do, how we manage the portfolio, and so forth. We'll spend some time just looking at the overall market backdrop, and then we'll dig in a little bit more to performance. So assuming that works as a plan, Sam, if we could go to page 6. And I don't want to belabor this. There's a lot of interesting numbers on the page. What I will say is that we began as a firm in 1973. We started working with educational endowments at that time. At the time, pioneering, if you will, sort of a portfolio management approach that really focused on a high allocation to equities and really embraced diversification. We've been building on that sort of initial legacy of innovation over the last 4 decades to become what we are today, which is a global investment management firm that helps endowments and foundations, pensions, and private clients implement and manage custom investment portfolios that seek to generate outperformance so that our clients can maximize their impact on the world. Okay? If we look at page 7, this is an overview of your investment team. I am the Chief Investment Officer. I am your Chief Investment Officer. And at Cambridge, this is really kind of an output of our view that our clients should not have to sacrifice the benefits of working with a globally resourced, fully resourced investment management firm, and the benefits of working with a boutique investment office that is focused on an individual basis on our clients. And so what we've done really is combine both. We leverage and sit on a global research platform, just under 130 investment professionals focused on scouring the investment landscape and finding the best managers and the best investment opportunities out there, and then helping our clients get access to those investments. In addition, we have an institutional quality operational infrastructure that's particularly relevant in this case because we are an OCIO and we need to not just make the hire and fire decisions, but we need to implement and manage the portfolio. So we benefit from that critical operations infrastructure to implement on your behalf. The takeaway is that we are fully dedicated to the foundation. We are fully aligned and focused on building the best portfolio that we can so that you can achieve your financial objectives, and most importantly, so that you can achieve your philanthropic goals. Okay? So let's spend a few minutes on investment philosophy. If we could go to, thank you, to page 9. It really all is grounded, and it sounds cliche, but it is true. It's really grounded in a long-term investment horizon. We've said this a lot over the years with Mary and the committee, and we've talked about this a lot. There's going to be a lot of noise in the market. There's going to be a lot of headlines. There will be volatility. We cannot escape it, and last year is a perfect example. To succeed, you need to be focused on the long term, and you really need to shut out that noise. To be able to do that, you need to have a long-term investment strategy that you can stick to. And to stick to a long-term investment strategy, you need to get that strategy right, which means we need to spend time getting to know you as a foundation, getting to understand the risk tolerance of the foundation, the investment objectives of the foundation, so that we build a truly custom approach that reflects the foundation's needs. And I want to be very clear when I talk about that strategy. I think it's really important. This is not a strategy that will allow the foundation or really any of our other clients to avoid bear markets. We did not avoid the bear market last year, but we withstood it. And the reason that we withstood it is because we all had an understanding of what the approach was. We built a well-diversified portfolio that could bend, but didn't break. And that's the name of the game. You want to stay invested. You don't want to sell so that you can participate when markets recover. And that's in fact exactly what happened. And last year was a perfect example of this approach. We do believe in active management. When we have a high degree of confidence that we will get paid to use active management, net of manager fees and expenses. And if we don't have that confidence, we will index. And we do have a fair degree of index exposure in this portfolio today, by the way. So it's a blend of active and passive. It's really not either or, it's all of the above. We do not make tactical bets in the sense of large bets, betting on the near-term direction of markets on the streets market call. We think that that's a surefire way to destroy value, and we also don't think that we have any sort of competitive advantage there. And by the way, we don't really think that many investors do. We will, when valuations get to extremes on the margin, employ modest tilts relative to our policy targets as a way to add incremental value. But the bulk of the value added that we hope to deliver, and you should expect us to deliver from this portfolio, will come from picking managers that outperform. That's really what we think our competitive advantage is. And then lastly, risk management. For us, it's not a tool or a model, although we have many, I assure you. It's really fully integrated into our investment process. It's part and parcel of our investment process. It begins, again, at the beginning of the relationship, setting the right policy and reflecting the guidelines and the risk parameters and so forth in an investment policy statement. That really becomes our rule book. It's then building the portfolio. It's the portfolio construction, building a well-diversified portfolio, not just by strategy, cap, geography, and so forth, but also putting together managers that add value in different ways so that we can deliver over time a more consistent return and a smoother return. It's how we think about position sizing so that no one single position determines success or failure. And then at the end, it is a lot of the day-to-day blocking and tackling with regard to portfolio management. So it's understanding the positioning that we have, it's understanding the bets that we're taking in the portfolio, understanding the unintended bets that we're taking in the portfolio, and doing everything that we can by being disciplined, by rebalancing, to mitigate and reduce those bets as much as possible. But the key takeaway here is that it's comprehensive, it's holistic, and it's integrated into everything that we do. Okay? So then on page 10, this is how we build portfolios. This will likely not look that novel, if you will. Diversified portfolio, for a portfolio like this, and quite frankly, for the bulk of our clients that are seeking to grow the inflation-adjusted value of this portfolio over the long term, we believe in having a high allocation to equities. And so we use public equities to do that, and private investments in particular to enhance the long-term return potential. We think private investments really represent one of the most compelling, important, and significant and highest returning strategies that we can deliver for clients. And so we do focus a significant amount of our time finding those ideas to really drive that long-term return. I think, as I said at the outset, we then have the diversifying strategies to try to reduce and manage that overall risk profile, give those alternative sources of return. It's a range of different strategies across long-short equity managers that are doing lots of different types of strategies that have, in many cases, very well hedged exposure, risk managed to ultimately give us strong risk-adjusted performance over the long term. And then again, the balance between the inflation hedging and the deflation hedging assets, those assets meant to give us liquidity in those very specific macroeconomic environments that can really wreak havoc on the portfolio. And then finally, on page 11, this is an exhibit that we've shown clients in the past. This is what we refer to as a quilt. It's less important than to try to look at every individual square and every individual color than it is to just understand that, understand what it is the message that we're trying to deliver here, which is Diversification is important because in any given year, that year's winner may be next year's loser and so forth. So what this is showing over the last 20 years is asset class performance from best to worst, top to bottom, across these different asset classes, whether they're commodities, whether it's real estate, fixed income, and so forth. The point is that you don't see the different colors consistently at the top or consistently at the bottom. That performance rotates. And so from a broader portfolio construction perspective, this is all about not putting all our eggs in one basket. It's about spreading our bets in a very diversified way. And ultimately, by doing that, we hope to achieve a more consistent pattern of growth that is more reliable over the long term. Okay? So why don't we pivot then to markets, and then I will have Tim come in to talk more specifically about the performance in the portfolio. So if we could go to the first page, and thank you, Sam. So what we're showing you here on page 13 are market returns both for the first quarter of this year and for the trailing 1 year. So I think I said at the outset, to a degree, equity market performance really kind of picked up where 2020 left off in terms of solid positive returns. Not to the degree that was delivered on the whole in 2020, but certainly continued. You know, whether you're looking at the ACWI, which is global equities, whether you're looking at US, non-US developed, and so forth. And what we have started to see is a rotation into more, let's call it cyclicality. Companies, sectors, assets that should do well in a more cyclical economic recovery, such as what we think we're experiencing right now. So things like commodities, NREs as natural resource equities, REITs or REITs, and so forth, have really kind of led the way here in the first quarter of this year. On the other hand, when you look at bond returns, you've seen general weakness. And that is, of course, because bond yields have crept up in 2021 pretty notably, and we've got a slide to show that in a few moments. But look at the bottom returns here for the same asset classes. This is for the trailing 1 year period. 55% for global equities, 59% for US equities, and so forth. Just shows you the magnitude and the strength of the rally from that market low. It shows you how far markets fell and now how far markets have come back over this time frame. So pretty remarkable when you look at that sort of endpoint sensitivity, if you will. And then again, going out to the lower risk end of the spectrum with those bonds, either muted or slightly negative returns over this period. Let's take a look at the next page. So I just mentioned about the bond returns being low. What we're showing you on the left-hand side is the change in 10-year government bond yields, whether you're looking at US Treasuries, which is the green, UK bonds, I should say, which is the sort of yellow color, and so forth. The takeaway is that in many cases, if not all cases here, bond yields have continued to creep up. Essentially a 0.8 percentage point move in rates since the beginning of this year. It's pretty significant to the point we are today, about 1.7. You know, the last I looked, we were relatively close to that number. And so obviously, as those yields have gone up, the prices of those treasuries and other government bonds have gone down. Fortunately, because we're well diversified, and fortunately, because just of how market returns have gone, you know, everything else that's been in the portfolio has offset that. And, you know, they play a specific role in the portfolio. That's why we have them. But certainly in a rising rate environment, these investments can be impacted. On the right-hand side, we're just showing you what the Fed indicates and thinks that rates will be out to the next 3 to 4 years, both in terms of the Federal Open Market Committee dot plot estimate, which is the yellow or mustard yellow color, I should say, and then the Fed funds futures curve, which is what the market thinks. There's a little bit of difference there, but the key takeaway is that it's very low. And the Fed has been abundantly clear that it does not intend to move on rates at any point in the near future. And they've had to continue to reiterate that. But that really is the intended policy perspective at this point from the Fed. So let's take a look at the next slide. So labor market conditions have seen a pretty significant improvement off of an unemployment rate that went up to just about 15% at the worst point in the pandemic, which is the unemployment rate line that we're showing you on the right-hand side. There's been a pretty significant recovery and improvement in labor market conditions. At the same time, we still have, and this is as of the end of March, 8.4 million jobs lost, the majority of which are coming from leisure and hospitality, which you would likely expect, education and so forth. But clearly, those sectors that are more tied to are not able to kind of work remotely, let's say, clearly have been impacted more than other sectors that can work more remotely. And clearly, leisure and hospitality is one of those important sectors there. Again, we have continued to see an improvement in labor market conditions, but we still have a ways to go to really sort of undo some of the damage that was done by this pandemic. If you look at page 16, the broader macroeconomic outlook, we are relatively constructive in terms of that outlook. When you look at growth forecasts, when you look at leading indicators, which is the composite PMI in this case, that stands for Purchasing Manager Index. It's an important leading indicator of broader economic conditions, continuing to signal expansion in most major economies. Anything north of 50 signals expansion. And that's been fairly sustained for the last several months, and we expect that trend to continue. Because of the fiscal stimulus and the ongoing easy money policy from the Fed, U.S. growth estimates have been revised significantly upward. U.S. forecast for U.S. growth in 2020, at the end of 2020, were 3.9%, which is that solid green bar that you see on the right-hand side. That diamond is where those forecasts have moved to today, 5.7%. It's almost 2 percentage points higher in terms of what the forecasted growth is supposed to be for the U.S. And similarly, high levels of forecasted growth for other major economies. EMU is effectively European Monetary Union, by the way, to the extent that anyone was wondering that. And then, of course, UK and China. So very robust growth, very accommodative fiscal policy, monetary policy. And so broadly, from a macroeconomic perspective, and there are clearly always risks, the number one being just, are we truly able to get this pandemic under control, or do we have some sort of resurgence that we don't know of yet? But in any case, at where we are standing today, very constructive from a broader economic backdrop. And so we do think with all the stimulus already in the economy and yet to come, combined with easy monetary policy and an earnings growth outlook that remains pretty robust, what I would say is that we think that creates a pretty supportive environment for risk assets in the near term. So why don't I pause there, and I will hand it to Tim to say a few more words about performance, and then we can open it up for questions. Why don't you go ahead, Tim?
All right, great. Thank you, Omar, and nice to see all of you. If we could jump ahead to the next slide, Sam, please. Great. So what we're showing here right now, top part of the page, is portfolio growth in dollar terms since we started working on the portfolio in July of 2016. And what you'll see is that there has been $51 million in portfolio growth, which brings us to that $115 million in assets currently, as of March, in the foundation. Of that $51 million in growth, just under 12 million, 11.7 million could be attributable to inflows into the portfolio, while the majority, just under 40 million, 39.8 to be exact, is attributable to investment gains. So in dollar terms, the portfolio has seen some really nice growth since we've been working on it, and really great to see that while we've been working on the foundation investment portfolio, it hit that $100 million mark and has since gone past it. So very, very exciting for us, and nice to see some great gains in dollar terms. On the bottom part of the page is investment performance at the total portfolio level across a number of different time periods since we started working. So starting with 2016, 2017, all the way to more present times. I'll just orient all of us to 2020 because I think it's pretty fresh in everyone's minds and fresh, data. What I do want to point out, 2020 ended up being a great year in terms of both absolute returns. The portfolio appreciated over 14%, but it was also a great year in relative returns. The policy benchmark portfolio was up just over 12%, so some nice value add versus the policy benchmark. And it's pretty remarkable if you think where we all were 1 year ago, depths of the pandemic, economies closing down, stock market across the globe trading downwards. But sticking to that long-term asset allocation, which is part of our philosophy that Omar said, really allowed the portfolio to participate in the rebound, really, and end up having a great year. Shorter term, the quarter to date, or the first quarter in 2021, the portfolio is up just shy of 3%. Some nice modest value add versus the policy benchmark return of 2.4%. Still really early days in the year. And that brings us to that trailing 4-year, 8-month. So that's since we've started working on the portfolio. That's since inception for us, to an annualized return of over 9%, which is again something we're very happy with and excited to see. So some nice value add there versus the policy benchmark. So we can jump ahead to the next page. This page shows asset class returns. So those asset class returns that collectively make up the total portfolio return that I was just talking about. Up top is asset class returns for the calendar year to date. So that first 3 months, first quarter of 2021. And at the bottom is the trailing 1 year time period. So up top, you'll see that equities have done well. They've continued to do well over the beginning of 2021. Our global equity allocation has led the way. It's up almost 8%. It's followed by our US equity allocation, which is up 5.5%. Emerging markets, which are up just shy of 5% at 4.7%, and then developed ex-US equities, which are up just shy of 5% at 4.6%. That purple or magenta bar in the middle, that's those diversifying strategies, the hedge funds. They've appreciated 1.6% through March. Orange bar is commodities. They after quite a volatile 2020. If anyone follows markets, you'll know about oil prices last year as well, and the subsequent rebound this year. It's not the only component of commodities, but it's an important commodity. Had a very volatile 2020 and was actually a negative returner for the year. Has since appreciated, up almost 7%. TIPS, which are those Treasury inflation protected securities, they're up just over 1%, and then Treasuries are down a little over 9% as yields have picked up over this time period. Longer term, at the bottom half of the page, we'll just point out that these are some pretty eye-popping numbers for equity returns. Omar mentioned this a little bit. If you put it into context, this is coming right off of the market lows a year ago. So this this time period does not capture that first quarter of 2020 when markets were down significantly. So this is basically the recovery to date through March. So some pretty big numbers. US equities have led the way. They're up over 60%. They're followed by emerging market equities, which have returned just shy of 60% at 59.4%. Global equities up 58.6%. Developed ex-US equities have returned just shy of 58%. Something I'll point out, we've seen some nice value add from these categories. All 4 public equity categories are beating their respective benchmarks over this time period, which is great to see. Elsewhere, those diversifying strategies, that purple bar, as we would expect, did not keep pace with those public equities given their risk return profile. However, did have some nice value add versus their benchmark, beating their benchmark by 5%. Still a great absolute return, just shy of 30%. We'll certainly take that. Really great return to see. Commodities up just shy of 35% over the trailing 1 year. TIPS up just shy of 7%. And again, Treasuries, sole asset class in the red. They're down a little over 10%. And we'll jump ahead to the last page in this performance section, which is effectively the same information, but this is over that long period of time since we've been working on that on the portfolio, 4 and 2/3 years to be exact. So, stories is actually pretty similar to the information I just presented. Equities have really led the way, double-digit returns across the board. U.S. equities are up the highest, up almost 16%, and they're followed by global equities, which have traded upwards 12.5%. Emerging market equities, which have returned over 11%, and developed ex-US equities, which have returned just shy of 11%. Diversifying strategies, they're up 4.4%. Commodities are the sole asset class in the red over this time period. They've had a pretty volatile return profile over this almost 5-year period. They're down modestly at 2.5%. Tips up just under 3%. Treasuries up just shy of 2% at 1.5%. And not on this page, but it's something I do want to highlight, are private investments, which, as Omar mentioned, is an important part of how we build portfolios and a return driver for the Montana Community Foundation portfolio. They're up 24% annualized since we've been working with the foundation, and that's versus public markets. So if you had instead invested in public markets, those are up about 10%. The reason that private investments are on this page, private investment information, it tends to be lagged because they have to mark their private investments. So that information is through September. However, what we've seen is that private investments have continued to do well in the fourth quarter of 2020, but not on the page, but generally a really great performance story for the private investments. And yeah, so I've covered a lot of ground. As Omar said, I think it's a good time to pause and just see if anyone has any questions, whether it's performance related, market related, philosophy related, Cambridge related. I think anything is fair game.
There was a question that came in for Mary, wondering if Mary could talk about who is on our investment committee.
Sure, I'd be happy to let you know that. Our investment committee is comprised of all Montanans. Some of them are board members of the Community Foundation, and some are not board members, but have maybe technical expertise in investment. So Dwayne Kurakawa chairs the investment committee. Dwayne is a banker in Wolf Point. Some of you might know him. Mac Clapp, a longtime investment expert doing a lot of institutional investing. He is not a board member, but a committee member. Ed Eck, some of you know Ed, who used to be the dean of a law school at the University of Montana, and also was with the Office of Consumer Protection here with the Attorney General's office for a few years. Dale Woolheiser in Missoula. I don't know if I'm supposed to say retiring. He says he's failing miserably at retiring as an investment advisor based in Missoula. Jack King, who is a landman and does a lot of investing over in Eastern Montana. He's based out of Billings. Greg Hansen, Georgetown Lake, was a practicing attorney for a number of years doing trust and estate work out of Missoula. Tanya Roop, who is with Arthur M. Blank Philanthropies Group. She's a board member and she lives in Wilsall. And Kelly Brueggemann, who is our board chair and currently the director lead of the First Interstate Bank Foundation and the Scott Family Philanthropies Foundation Group. So that is who, and myself, those are the members of the investment committee.
Thank you, Mary. We had another question come in. An attendee says, I believe that inflation is estimated to increase. Do you see an increased play in tips?
Maybe we'll start with the first part of that question with regard to inflation. So you all likely saw that the most recent readings came out and they were higher, let's say, and certainly above what let's say consensus expectations would be. Now, I would argue that part of those readings, some of that was already expected by the market. What likely wasn't expected by the market was actually the month-over-month change in inflation, which I think came in at about 0.9%. And if you just, game that out for a year, you're looking at, 11, 12, whatever it is, percent for the year in 2021, which would be massive. And that would be well north of what I think anyone in the market is expecting. But when you look underneath those numbers, there really were kind of three primary drivers that kind of accounted for the lion's share of that move in inflation. The first was a pickup in used car prices. That was driven by sort of bottleneck supply constraints for chips that go into the cars, semiconductor chips. You've likely heard there's been a shortage. And so that really placed upward pressure, both on used cars and new cars, by the way. We do expect that ultimately that will normalize as the supply bottlenecks, if you will, resolve themselves, hopefully over the next couple of months. The second piece was a pickup in travel, leisure-related services, airlines, for example, hotels, and so forth. We do believe that a big piece of that will likely actually normalize as well, and we think it, in a way, kind of in retrospect, probably should have been expected, as our economy really has over the last month or two begun to really reopen in a meaningful way. And then the last piece is it's just retail sales for a host of different items that likely benefited from folks getting rebate checks, stimulus checks from the most recent round of stimulus that likely placed some upward pressure on those prices. We still believe where we're standing today that those pressures are somewhat transitory. It doesn't mean that inflation may run a bit higher than what the Fed would prefer or what the market prefers for a period of time. But do we think that that's a sustained increase, a sustained new normal? We don't think that that's the case today, particularly when you look at other elements of the inflation that goes into that basket that really will drive it, meaningfully. Things like shelter, you look at rent prices, that kind of thing. They were relatively stable month to month, and so that gives us some degree of confidence that perhaps this will normalize a little bit. So it is something that we're paying attention to, but our base case view is that while it may be a bit higher for a period of time, we don't expect it to become a new normal, and we don't, based on what we know today, expect it to become a problem. Obviously, the tips that we have in the portfolio have benefited and will benefit to the extent that we see inflation surprises. Similar to interest rates, we really don't think that we have any skill in calling the direction of interest rates. We don't think we have any skill in calling, what's going to happen with inflation. We think most people can't. If you look at economists' track records, whether it's inflation, interest rates, it's been notoriously bad. In this case, we really are going to take that long-term view. We have that exposure, and so if inflation does surprise to the upside, this portfolio will benefit. We also do have some commodities futures exposures that has benefited. And there, while we're not being tactical, we're also being prudent from a risk management perspective and have been actually taking profits there, if you will, and rebalancing as we've seen kind of a rebound and a rally, if you will, in those types of assets. And then the last thing I think I would say, that part of the portfolio is really not about making a tactical call. It's about buying time. In this specific case, if it's a surprise in inflation, that's really what you worry about, is a surprise. You don't worry about high inflation. You worry about inflation that comes in well above expectations that people weren't planning for. We think we have enough to allow the foundation to buy time. And if you take that longer term approach, we have plenty of assets that will do well if we have a sustained period of inflation over a longer period of time, namely the equities that actually do well, on a 5-year look in a period of elevated inflation. So we feel like we're well positioned, but just philosophically, we're not going to make the call on inflation. At the same time, we pay very close attention to this. And if our view changes, if we think that there's something that needs to change in the portfolio to improve that profile, we certainly would do it.
Thank you. We had another question come in for Mary. I believe Mary said MCF has $150 million in endowed assets. Can you discuss how the other assets are managed?
So I had intended to say total assets, so not all endowed. So obviously we have a large chunk with Cambridge, but we have also a nice large amount also that's non-permanent and non-endowed. So if I misspoke, I apologize. The 150 is total assets.
All right, that's all I see in the chat. Are there any other questions you'd like covered? Looks like, is it Jack?
It's Jacques, and I'm new to this group. I haven't actually taken over as treasurer of my organization yet, but that happens in less than 2 weeks. So I am just curious, is there a way to have a glimpse of more specifics with the portfolio?
Mary, you can jump in on this as well. You know, we're happy. You know, we obviously when we meet with the committee, we actually just met with the committee earlier today, and you know, we provide as high degree of transparency as folks want to have. So if there's interest in that, from my perspective at least, we're more than happy to do that. Is there anything in particular you're thinking of?
Well, I'm just curious to get a glimpse of, you talk about going after superior managers or your some of the areas of some of the positions that you have in areas that most of us aren't that familiar with. I'm just curious to see more specifically what kinds of things they are.
Yeah, I mean, again, we're happy to provide that that transparency if it would be useful for folks. For your awareness, if nothing else, you know, we do kind of take a closer look at things like manager level attribution when we meet with the investment committee. So we go kind of a layer deeper in terms of performance drivers, both good and bad. But again, we're very happy to provide that to you or anyone really if it would be of use.
Thank you.
Any other questions before we sign off today? Well, you know how to reach us if you do leave and think of a question you forgot to ask. But appreciate you being here today. We are going to have a recording of this available too if you want to watch it again. It'll be available on our website in the next couple days at mtcf.org. So with that, thank you to Cambridge Associates for being here and for being our partner in all this. And thank you again for joining us today. I hope you enjoy this beautiful day.
Thank you. Take care,
Thanks,
everybody.
everybody.
Take care.
Thanks.
Bye.